The S&P 500 looks fairly mixed today, with some companies performing very poorly and some others that aren't looking too bad. However, our focus is on one of the worst performing, not just today, down 5%, but the Estee Lauder company is in fact right now trading at its 52-week low. Now bear in mind, this company over the last year is down 42%, so what is going on with this company? Is it now looking like a must buy with some very good growth over the next few years? We're going to deep dive today, and firstly we want to point out that they did release their earnings on Monday before the market opened. So we're going to see what happened, what were the results, and whether or not we have some optimism with this company moving forwards. So first thing to note, when we do take a look, what we can see, they posted quarterly earnings of 64 cents per share, looking very good given the analyst was around 25 cents per share. On top of that, just from the same quarter last year, 7 cents, meaning a very strong beat from the consensus estimate, as well as what we can see here, they did perform significantly better than the same quarter last year. On top of that, they also beat on the revenue, 3.87 billion for the quarter. We can see here analysts were expecting 3.61. So off to a good start. So far we see a double beat on the revenue as well as the earnings per share. A few other things to go through. They did in fact decrease their forward-looking estimates, as well as the CEO now announcing that he will be departing. So when we take a look at some of the details, we can in fact see Frieda, 66, will be officially retiring next June, and he has been the CEO of this company since 2009. On top of that, what's very interesting to note is that not only will he be stepping down, but in fact it was just released last month that the CFO, Tracy Travis, will also be stepping down. So you've got two very key players in the management team, both the CEO, as we've just heard, as well as the CFO. And what's also interesting is it comes at a time where they have released some very poor forward-looking data. They now expect their sales for the full year of 2025 to fall as much as 1 or 2%, which when you compare that, analysts were expecting a rise above inflation of 6.4, so not looking great for the next full year. We also note for their EPS, they are anticipating around 275 to 295, a massive drop from analysts' expectations of 396. And this is interesting to note because the demand for these certain affordable luxuries like the lipsticks and perfumes, which we do consider to be recession proof, have taken a massive hit, as well as their segment in China. So something just to bear in mind as we do go along today. There are reasons why we see companies' share price being hit, but in fact we could argue that some cases the market has overreacted, giving us what we could argue to be a generational buying opportunity. Now they are down 42% over the last year, and over the last 10 years, if you have been a shareholder, you would be up only 15%. If you include dividends reinvested, marginally higher, but a very, very poor return on any investment. And since their highs around $370 in December 2021, nearly 3 years ago, this has been in a downward trend from that $370 mark. We are talking about now a current trading price of $88. Now, as we said, right there at its 52-week low, we have a buy rating, however, from Wall Street, although fairly weak at 3.57 out of 5, a hold from Seeking Alpha, and a sell from Quant. This does currently offer a yield of 2.84% and a forward P of 24.6, marginally higher than the S&P's 23. Now, we also want to run through their dividend safety as well as some underlying metrics. First thing to point out, borderline safe score, so not the greatest. We can in fact see with the drop today, the yield has hit the 3% level, and we are still waiting on a more recent dividend increase. Now, what does the 50 score mean? Well, first thing I want to point out, it has been downgraded just last month, and what this now means is that there is a moderate risk of a dividend cut over a full economic cycle. So the last recession, how did they perform given that this industry is meant to be recession proof? Well, they actually maintained the dividend during the 07-09 Great Recession, didn't increase it, but also didn't cut it. We know they had negative 11% sales, not far off the average of the S&P at negative 12, and we can see here negative 52% recession return near the S&P's negative 55. So we wouldn't really associate Estee Lauder based on historical data as a recession-proof stock. Now, we have noted, however, over the last 5 years, a 12% increase to the dividend, as well as over the last 20 at 18% per year. And we can see just 3 years of consecutive increases, a few cuts just over the last 20 years. Now, dividend yield theory, as always, it does state a company is undervalued when the current yield sits above the 5-year average. We have a massive sign here of undervaluation, severe to be in fact. 2.99 versus the 5-year of 0.97, and this does look to be the highest yield they have offered over the last 5 years. We also have a double undervaluation signal with the forward P of 29.9 below the 5-year of 41.5. However, when we do take a look at the consumer staples sector PE, it does sit much lower at 17.9. Regardless, we never look at any one of these models in isolation, and we will conclude towards the end with our own valuation price as well. Free cash flow payout then, as always, we draw your attention to that as the earnings is susceptible to manipulation by management through accounting. Below 60% is the target because we want to ensure they can offer double-digit increases that we love to see, and in fact Estee Lauder have historically offered 42% in 2022, and in fact for the majority of the last 10 years below 60%. 2023 at negative 59%, going to see now that they were negative free cash flow. Over the next 12 months though, at that 87% level is fairly high, and we are potentially looking at a very, very mediocre increase. Something just to bear in mind though, and we can clearly see here, free cash flow over the longer term, as we want to see with this metric increasing. However, negative free cash flow in 2023. Positive to note, over the next 12 months, it is anticipated to increase. Firstly to positive, and secondly to nice $3.05 per share, but it's something we can keep our eye on moving forwards. We then move on to the sales growth, where we want 3 to 7% year on year, at a bare minimum just 3 to 4 to ensure it is increasing in line with inflation. However, over the last 10 years, we do in fact note 4 of them have been negative, including FY24 at minus 2%. And when we look at it from a numerical standpoint, it has increased around 50% from 10.8 to 15.6 billion. Now, as always, we love it when companies do share buybacks, returning excess cash to our pockets, something they have done, but incredibly trivial and very inconsistent, so not much to discuss with relation to this metric for Estee Lauder. And in terms of the ROIC, one of our favorite metrics, 10% or more, give us faith management are able to effectively allocate their capital, something we have historically seen, but it has come down from the highs of the 30s from 2015 to 2019, so at 10% over the last 2 years, this is really the minimum we want to see. Again, something just to keep an eye on given the downward trending nature, not just of the metric, but also as the share price. We then move on to the operating margin, where we want to see above 12%. Ideally, we want to see operating efficiency, as we always note, increasing over the longer term. Not something we see with Estee Lauder. In fact, 2015 to 2022 looking very good, but then it takes a massive hit over the last 2 years, and in fact decreasing. Again, something that we need to not just consider, but also factor in when we look at our margin of safety later. And not looking too great. Free cash flow margin, whilst it was above 5% over the last 10 years, looking very healthy, we do see a massive drop into negative territory in 2023, and on a trailing 12-month basis at negative 8%, not something we really want to see. On this channel, what we love is that consistency, not something we've got a lot of with Estee Lauder so far. Then move on to the final metric, the net debt to EBITDA, the earnings before the interest, tax, depreciation, amortization. With the numbers that you see below, number of years it would take the company to pay off all of their debt net of cash on hand. Remember, below 3 is what we want to see, and why this is incredibly important is that it correlates to both dividend safety that we saw above, which was borderline safe, as well as fact the balance sheet strength, which we will also come on to shortly. So it is fairly high at 2.67, in fact a 10-year high. We do know, however, it is anticipated to come down to 1.93. If they can get this lower and also get hopefully the free cash flow payout lower as well, that will help alleviate some of the stress right now on that low dividend safety score. Now, we also like to look at both insider and institutional movement. Insider ownership at 13%. We actually see around 8 million worth of sales over the last 12 months, although we do note nothing in quarter 3, no buys, no sales. In quarter 2, that is where we see the bulk of the selling. Now, when we take a look to see who these insiders are, in fact, the more recent one was by the EVP. In fact, that was the 30th of May, so you could argue that was a little bit outdated, and in fact, that was around $1.8 million. Now, we do show this for transparency. However, insider selling isn't something we typically see as bearish. Insiders sell for many, many reasons, personal, financial, and a lot of others. However, what we ideally want to see, that is why we incorporate this in our analysis, are insider buys which we believe is bullish. Ultimately, insiders do buy their own shares because they believe the share price will go up. We then move on to institutional ownership at 55%, around 5.2 billion worth of sales over the last year, with around the same amount of buys, 5 billion, so not massively more sales than buying. Over the more recent quarter of Q2, we do know marginal more buys by institutions than sales. In Q1, we do get the opposite. So overall, insiders are selling, institutions are selling a little bit more than buying. However, as always, do your own due diligence. Never copy what insiders or institutions do. Now, we also want to let you know that we have released our latest free weekly article where we run through what these super investors have been buying and selling over the last few months. You also get access to all these other articles completely free, so do click up on the pinned comment below to start reading. And we've also released our 35 dividend stocks for the month of August to consider in the portfolio, as well as those that sit within our own portfolio as well. As always, do click below where you can grab a copy. Next, we want to just run through the income statement. Now, we've already gone through the top line revenue, so the main part here is the net income. But just a quick recap, 11 billion to around 15.6 in June 2024. Over the longer term, it has been increasing, but as we mentioned, a little bit inconsistently on a year-on-year basis. And the main thing that we want to see is what story do we get on the bottom line? Well, 1.1 billion in June 2015, around 390 million in June 24. That is going the wrong way, not something we like to see in any company we invest in. And in fact, from June 2021, the bottom line has been getting smaller and smaller. We would call this a red flag indicator and definitely something to consider if we're not getting a very, very hefty margin of safety. We then want to run through the balance sheet where we want to see the health of the company, their total cash versus their total debt. They had around 1.5 billion in June 2015, and it's more than doubled in their latest quarterly report at 3.4 billion. So over the longer term, whilst it is still inconsistent, their cash balance has been increasing. And remember, in isolation, that number tells us absolutely nothing, which is why we do compare it to their total debt numerically and directionally, which, as we can see here, has been increasing over the longer term. Again, not the greatest of signs of any company we want to consider. 1.6 billion in 2015 to around 9.8 in that latest report. So do bear in mind lots of factors with this company that we have highlighted for your serious consideration. And another thing we like to look at is the earnings per share. How do they perform against analyst estimates? What are future expectations? And we're off to a very good start. They have beaten, in fact, the last 4 quarters by quite some considerable margin, as we can see, 39 cents in the more recent, so 100% track record. And even with the anticipated negative drop to the earnings per share in Q1, we can see the subsequent 3 are positive. And with their June 2026 estimate at 4.41, that will bring the forward P down to around 21.06. Maybe something you are more comfortable with, especially if you believe they can hit the targets that they have set as well. Then we want to look at some underlying metrics and gradings. The first one, the valuation grade. Now they get a D-. Main reason for this, when we look at, for example, the P on a non-GAAP forward basis, 24.6, the sector as a whole at 18. So right now today, if you are buying Estee Lauder in the market, you are paying a 38% premium. As we mentioned though, sometimes it is worth it. Some companies are high quality enough that deserve it. It is warranted, and that is what we want to understand in today's episode. And that is the overall underlying thing to point out here. Regardless of which metric or valuation you use, Estee Lauder does trade at a fair premium to the rest in the sector. Then we take a look at their growth grade. Well, not looking good. If they're trading at a premium, why are we getting a growth grade of C? Well, year-on-year growth, -2%, whilst the sector is at 2.23. Forward looking around 2.9, sector as a whole not too far off. And one thing we always like to draw your attention to, earnings per share moving forwards over the next 3 to 5 years, anticipated 13%, with the sector looking lower at 7.61. So that is a positive sign in terms of what they are doing that is expected to outperform the market. So we can say actually maybe a C is a little bit unjust and it could be a B grade. We then move on to the profitability where we get another C, although we do note their gross margin looking very, very good, 72%, sector at 36%. Their bottom line net income, though, that is very poor. If they are getting a gross margin of 72 and their net income is 2.5, something is going terribly wrong, and the sector median sits at 4.31. Now, just bear that in mind. Gross margin of the sector is much, much lower at 36%, yet their net income is higher at 4.3. Finally, the thing that we do like about this is that their cash from operations is very high, 2.2 billion, with the sector around 800 million. Now, just for a quick recap for this part of the analysis, we have a buy rating from Wall Street, a hold from Seeking Alpha, and a sell from Quant. In terms of the valuation, well, D-, growth C, and profitability C. Now, we are going to jump into the valuation. Just before we do that, we want to see how have they performed against others in the sector. Are there any trends that we can spot, in fact, with the industry as a whole? We're looking at some very well-known other companies, Kenvue, Elf Beauty, Coty, some very, very big names in the market. And this is the total return, so includes dividends reinvested. Estee Lauder, the worst performing, down 40% over the last year. But what we also spot, in fact, out of these 6, 3 of them have also had negative returns over the last year. So you could argue there are issues with the market as a whole. Consumers maybe aren't buying as many products as anticipated. And when we expand over the last 5 years, we can in fact see Estee Lauder again down negative 53%, and we can also see a few others not performing too great. In fact, the standout performance from here is Elf, up 803%. Over the last 10 years, Estee Lauder up 30%, but again, not great performance right across the board. The only one you would really be satisfied with is Elf, up 532%. But as always, past performance is not an indicator of the future. Estee Lauder could do a lot better and Elf could do a lot worse, but just some things to consider before executing on a company, and hopefully a few other considerations in your investment thesis. Now, as always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Now, our intrinsic value of $109, how we got to this value? Well, we ran it through the 4 models. We had Graham's valuation, the earnings per share for EL, the long-term growth rate, the yield on AAA corporate bonds, giving us our first intrinsic value with a signal of overvaluation. As always, though, we're not looking at any one of these models in isolation, and we will conclude with the summary. And then we have the multiples valuation, companies in a similar sector and size that we just ran through, their average P multiplied by the EPS of EL to give us our second intrinsic value with an undervaluation signal, so 1 for 1 currently. We then move on to the DCF model with the free cash flow year on year. Average growth around 6%. Forward looking, we have gone for around 9%, which is lower than what management are targeting. With the discount rate, we get the present value of future free cash flow and terminal value. Bearing in mind for 2024, we are using analyst targets. And we add with the cash, subtract total debt, get the equity value, divide by the shares outstanding, and we get our third undervaluation signal. So the intrinsic value in today's episode is just the average of those 4 models. And as always, you can grab a copy of this model by clicking on the pinned comment below to run your own numbers through, whether it's for Estee Lauder or any others. Now, before looking at our margin of safety, we can see Wall Street do disagree. They see a significantly higher target price of 127 over the next year, believing this company has 44% upside and is definitely a buy and consideration. Now, with MOS, we always use a 10%, which we execute on if it hits our 3 golden criteria: wide moat, strong financial metrics, and good forward-looking data. Now, at 10%, a buy at around $98, at 15% around $93, at 20% around $87, which is pretty much where it's at. Now, if you believe in this company over the longer term, maybe a 20% margin of safety is very attractive, especially given Wall Street have 44% upside. For those that want a larger MOS, well, at 25% a buy at $82, at 30% around $76. But as we said in today's episode, 20% MOS with 44% upside. Now, for me personally, this isn't one I will be looking to add. We ran through the metrics. They look very poor. A large number of red flags that we did raise. For example, their net income has been decreasing over the last few years. They've significantly lowered their forward guidance. We had both their CEO as well as their CFO resign, even though that won't take place till next year. And we had a lot of their metrics deteriorate just over the last few years. And one of the most concerning factors for me was that whilst we see this have phenomenal gross margin, probably double what we see in the sector as a whole, we noticed that their net bottom line margin was a lot worse off than the sector. So a lot of things that in terms of the overall, when you do add them up, for me, regardless of the MOS, this isn't one that I would consider adding. As always though, do give us your thoughts below. Maybe you disagree, maybe you believe this is a strong buy, or maybe in fact at a 20% MOS, you do believe this is one to seriously consider. As always, if you enjoyed today's episode, smash that like button, hit that subscribe and bell button so you are continually notified of these videos as they drop. Don't forget to click below so you can sign up to the free weekly newsletter, as well as joining us on the Patreon to talk about our buys and sells on a weekly basis. As always, have a great day and we'll see you all on the next one.